Will rising interest rates affect your self-storage loan? Will it affect your ability to get in the self-storage business or grow your self-storage business? Let's take a look at this rising interest rate environment and your self-storage business. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Self-Storage Quick Start Academy. And what I do is I support the small investor who wants to get in the self-storage business or wants to grow their self-storage business, strategically do so in a way that creates true wealth and a fulfilling career. And you can find out more about the support I offer at creatingwealththroughselfstorage.com. All types of training there, free, and has links to the Quick Start Academy and the Storage World Analyzer. But in today's world, interest rates are going up. Yes, they're going up slowly, but interest rates are rising. How does that affect you? In historical terms, interest rates are still pretty low. But we are in what's an environment of what I'll call a gradual increase. Interest rates are going up. For this episode, there's two types of loans. One is bank loans, and one is what I'm going to call permanent loans, the commercial-backed mortgages, CMBs. Let's start with bank loans. Bank loans are what most of us use, especially if we're getting in the business of self-storage. This will include SBA loans because they're loaned through a bank, although there is the federal government's guarantee of a portion of the loan, but it is a bank loan. Banks typically, as you know, require 25% down, 20-year amortization, and a 5, 7, 3-year call. Most banks keep those loans on their books. Unlike residential mortgages where they sell them, they keep them on their books. That's why they have the 3, 5, 7-year call. Now, the interest rates that you get quoted, if you get called today, the interest rate you get quoted in almost all cases will be a function of the bank's spread over their cost of money. And their cost of money is whatever the federal fund rate is. Now, the rate at which central banks loan most other banks and lending institutions money is usually set by the Fed. I'm sure you've heard it. The Fed met today and they raised the prime rate, or they raised the federal funding lending rate. What that really is the Federal Open Market Committee, and they meet 8 times a year, and their job is to oversee the economy and try to keep money moving and inflation down. And one of the tools that they use is the federal fund rate, the rate at which banks can borrow money. If the inflation's rising or the economy's too hot or hot, they raise the rates, which has an effect on what the banks charge. And when they're trying to stimulate the economy, they lower the rates. Part of the reason that they may be doing the gradual raising now is in anticipation of the next recession. At least they'll have some room to go down. If they don't raise the rates and they're already at the bottom, then they've lost one of their main tools. But usually that's a 2% spread difference or so. If you're a high risk, it'll be higher. If you're a lower risk, it could be lower. But on average, it's about 2% over whatever their rate is that they can get their money at. So when the Fed meets and the prime rate goes up 250, quote, basis points, which is economic speak for 0.25% of interest, that's going to ultimately get passed on very quickly to you. And what's happening is interest rates are going up. Now, sometimes they'll meet and pass on raising it, and then the next time they get together and it goes up. They typically meet 8 times a year. I wish they only met once. So what does this mean for you? Well, a couple things. First of all, get a quote. interest rates are going up. Our interest rates today, if I call a bank and get a loan today, it's higher than it was 12 months ago. And where it really affects us is in our future years. In other words, you're going to refinance it. And in our models, we will buy a project, very often do a value add, then build the value and then refinance it and give the money back. I've got to guess what the interest rates are going to be 5 years from now. So that's higher than it used to be. Typically what we do is whatever the current rate is now, I'll make it 2% higher because I have no idea what it's going to be. Theoretically, as interest rates rise, pricing of existing self-storage should stabilize and eventually start going down. Why? Well, because a higher interest rate is harder to get a yield at a high price. And cap rates should start rising for the same reason. I haven't seen much of that. I've seen somewhat of a leveling off of prices, but I haven't seen the market really begin to react and adjust to the changing environment yet. I think that's to come. But it does make it harder to do, especially the value add deals today with the rising interest rate, because more of the cash flows going to the debt service. So if at all possible, fix your interest rates. Now, I know it's not always possible, especially with some of the SBA loans. You can't fix those. They're gonna float. So be very sure in your performance to make adjustments for them. Don't start adjusting your operating expenses. You could adjust your yield expectation, but don't start adjusting anything other than the interest rate and the offering price. Now, if you couple the rising interest rates with, especially if you're doing value add plays, the increasing cost of construction, and the primary driver for the increasing cost of construction today is the economic policies coming out of the White House, specifically the steel tariff. What that's done is that has, in some cases, doubled the cost of self-storage facilities. So as a small investor, you're experiencing a double whammy right now. You're experiencing much higher construction costs, material costs, and you're experiencing rising interest rates. It makes it more challenging to do a deal. Be careful. We're being very careful right now. Also, we're moving into an environment where there's a lot of product. As we've talked in the past, know your submarket. I've got a couple submarkets now that aren't performing as well as we'd like, and it's not fun. So make sure you know that submarket. Now, the good news, and believe it or not, there is good news in the rising interest rate conversation, is the CMB loans. Ever since I've been, or this last go around, last 10 years of self-storage for me, bank loans have always been lower than the CMB loan interest rate. Now, what the CMB market is, this is what we call a permanent loan. It's for stabilized facilities, more institutional grade facilities, and they're a permanent. In other words, they sell these loans on Wall Street. So we'll put a CMB loan on a property, and that loan of ours gets packaged with other instruments, other loans, and other financial instruments, and then it's sold. And when it's a 10-year loan, it's a 10-year loan. You can't prepay it. If you do, there's a thing called defeasance, and in other words, it's not a prepayment penalty. You have literally got to replace that loan with something else that pays the same yield for the balance of the 10 years. I've been involved in 2 transactions where defeasance was there, and in both cases it was $250,000, well over $200,000. So if you do a CMB loan, make sure you're going to be holding on to that. But the good part about it is it's non-recourse unless you violate some of the lending covenants. It's a non-recourse loan. So when very often after we'll stabilize a property, we refinance it, put the CMB loan on it. Now the CMB loan interest rates have been indexed to the 10-year Treasury bill. And what's interesting is the Treasury bill is still over 3%. So it's an unusual situation. In the past, they've gone down. Now they've been leveling out, even with the rising interest rates. And we're seeing quotes now of 2, 1, and even as low as 1.5 over the 10-year Treasury bill. Checked a couple days ago, it was 3.18. So you could get an interest rate today, 5.18, 5.25 on down. For the first time, the CMB interest rates are lower than the bank loan rates. So it's never made more sense to explore getting a commercial or a permanent loan than it is today in the past 10 years. So if that's a possibility for you, really explore that. Call a good commercial mortgage broker or find a lender who does them and get some quotes on them. So, to summarize, be more diligent and careful today in your performance. Interest rates are rising. I think they're going to continue gradually going up. There'll be times where they meet and nothing happens, but I think it's going to gradually go up. I think it has to, because in the next recession, that's the Fed's main leverage point to help the economy, is to lower it. And they've got to raise them so they can get them down. That's my take on it. But I think it'll be a very gradual increase. But don't forget about it. Make sure you account for it in all of your performance. So you do that, and you buy them in markets that are healthy, and you buy them where you can get your yield requirement, and you're not adjusting it for higher interest rates or hoping that the interest rates go down, you'll do very well in the self-storage business. So thank you very much. I look forward to being with you next week. My name's Mark Helm. I'm the author of Creating Wealth Through Self-Storage, and I'm the creator of the Storage World Analyzer. That's the financial analysis tool we use where I'm inputting the higher interest rates, where I'm projecting what the future interest rates and future values are going to be. That is how we determine what we can pay today for a project or a piece of land in order to do a self-storage project. If you're not using it, I invite you to look at it. It's designed specifically for self-storage. You can go to creatingwealththroughselfstorage.com and explore the Storage World Analyzer tab. Also look at all the other training that's on there under the training blog section. Thank you very much. Look forward to being with you again soon.